Hi everyone, Shaun Humphries here. Welcome to All Things Retirement. In this installment, this video installment of our series of videos, we're going to talk about retirement investing and why your asset mix is critically important. And in fact, it's a very important part of the investment management process. We obviously live in a world full of change, economic changes, capital market changes, personal changes, tax changes, all kinds of changes swirling around us that impact on our portfolios. So when we talk about asset mix, that's a part of a series of strategies and ideas that we can build into our portfolio design to help us weather the ongoing changes and dynamic fluctuations that take place all around us. And it's a strategy that increases the probability that you will achieve your long-term financial goals and objectives. Now, when you talk about retirement planning and investment planning, again, this is our model. You are at the center of this. When we work with our own clients, we want to make sure that we're dealing with all of these areas in the context of building out the plan. Today we'll talk about investment planning, but obviously a successful retirement plan takes into account purpose and cultivating a vision for your retirement years, making sure you're doing what you can to maintain health, vitality, and energy, having concrete goals, not just for retirement, but for the aspirational part of your life, understanding your pension, your investments, tax, and estate planning and legacy planning, how those all tie together in the context of your overall plan. So obviously today we are going to talk a little bit about investment planning and one specific area of investment planning, which is your asset mix. Now, why is this topic important? Again, we've alluded to this in the past, but many people are disappointed with their portfolio return experiences. And one of the main reasons is because of a lack of disciplined behavior on the part of many investors. Study after study confirms that people underperform basic investment benchmarks, often underperform the very products and services that they purchase for their portfolios. So anything that we can do to enhance the level of discipline that investors can exhibit through their investment time horizon is well worth the effort. And so asset allocation, understanding how asset mix impacts performance, is a really important piece to that discussion. Now, we talk about retirement goals in the context of asset mix because this is where it all starts. Your aspirational goals, your personal goals, and then your retirement income goals will help to define the specific returns that you need to aspire to reach your objectives. And asset mix design has a very large impact on whether you are going to achieve those investment goals that you're aspiring to. So there are a lot of challenges in retirement. The one we're going to deal with today is how do we provide as much predictability to portfolio performance as possible, and again, asset mix is one of the strategies to use. So when it comes to investing for retirement, it can be challenging partially because we are just inundated with all kinds of information. Books with different perspectives, radio shows, our neighbors, advertising, the internet, family, school, all this information swirling around us. But what we try to do for our clients is try to distill the 3, 4, 5, 6 key principles that they always have to be mindful of to achieve their investment planning goals and ultimately their retirement or wealth planning goals. It's not about get-rich-quick schemes. It's not about the hot tip. There are strategies that asset managers, global asset managers, pension plan managers use to help provide some level of predictability to this whole investment experience. And designing an asset mix that's consistent with your goals and objectives is one of those strategies. So we can fight against all the, information, noise that's out there that sometimes, gets us sidetracked in terms of what actually we need to be doing to be successful with our portfolios. So in terms of the importance of the asset mix, I want to look at this chart a little bit. How you choose to diversify your portfolio is one of the most critical investment decisions you will ever make in your portfolio design. And asset allocation is a major determinant of portfolio performance. Now, I'll have in the notes below the video some content from studies that have looked at the whole area of strategic asset allocation and asset mix. But in general, the studies parse out that roughly 90+%, 91, 92% of portfolio return experience is driven off the asset allocation. And when we talk about asset allocation, that's really the mix of things like government bonds, corporate bonds, stocks. It could be big cap, mid cap, and small cap stocks. It could be stocks in different sectors, stocks geographically weighted between Canadian stocks, U.S. stocks, global stocks, emerging market stocks, and of course, real estate. It really is the mix of those investments that is going to drive ultimately the return that you experience on your portfolio. Over 90% of the performance is going to be driven by that mix, and we'll come back to that in a minute. In terms of other factors, market timing was 1.8%. Over the long term, timing the market didn't really make a huge difference. Now, obviously, if I put a whole bunch of capital into the market today and the market goes down by 15%, I've got a bit of inertia and headwinds I have to fight through before those long-term numbers start coming back for me. But they found that over time, the whole timing issue wasn't a critical component to the overall performance. Security selection. Now, security selection drove about 4.8%, and that can be in various areas. It could be, do I buy ABC investment product or XYZ investment product, or I use this portfolio manager or that portfolio manager, this security, that security in the stock market. Those all have impacts, but when you look at the grand scheme of things, provided that you're buying high quality investments, that you have reasonable diversification in your portfolio, overall it seemed that the security selection decision on a broad-based portfolio where capital preservation and growth were important priorities didn't seem to be a huge factor. So if asset mix is critically important, I think it's obviously important that we sort of unpack this and try to understand it in a little more detail. So this is a great chart. This is a discussion on something called the efficient frontier. And so what I want to do is I want to unpack the efficient frontier chart in a little more detail for you. We're going to take a look at what these visuals mean and how you can look at the efficient frontier in the context of how you design your portfolio experience. Now, the efficient frontier I'll define for you in a minute. I'm going to walk you through this exercise, just doing some annotations on this next section of the video. So let's take a look at the efficient frontier. So what you see in front of you is that schematic that we had just illustrated on the screen, and we called it the efficient frontier. And so what we're trying to illustrate here is that along this continuum here, we have return. And for the purposes of the illustration today, I'll just say that right at the midpoint here, let's say the return was 7%, okay? And then down further along here, we'll say return was 4% for the purposes of our illustration. Now, cutting across the bottom of this chart is risk. In other words, the level of financial risk that we're taking on to achieve our returns. Now, generally it's accepted that the more financial risk that we take on, the greater the return potential. Now, again, when we talk about financial risk when it comes to portfolios, and again, this is assuming that we're designing a portfolio where capital preservation is critical, while at the same time we are participating in variable return or capital market driven return investment products because we need to. So for many clients in retirement, and the last 10 years has been a good example of this, returns have been very, very low. So if you look at, in Canada, the 10-year Government of Canada bond yield was hovering around, just over 2% for a long time. U.S. 10-year U.S. Treasury bonds were hovering, let's say, 2.3 to 2.5%. Well, inflation was at least that. And so for a lot of investors, they couldn't afford to just buy government bonds and achieve their retirement objectives. They'd be basically going broke safely and eroding capital way too quickly with those kinds of yields. So as a result, they had to use portfolios that exposed them to more growth. And as a consequence, they needed to try to moderate risk as much as possible during their retirement years. So risk is sort of that year-by-year fluctuation of return on an investment. So we can have one investment that looks like that from a risk return standpoint, and we can have another investment that looks more like this. And obviously the investment that's in the red might be the investment that a client may want to have in place, particularly if the terminal return at the end of 5 years or 10 years was the same. But generally speaking, the more risk that we take on, the higher the return we would expect, but we have to cope with these periods of underperformance to get that additional return. So again, going back to this chart, you can see going across this chart is this line that we call the efficient frontier. And along that line are all the portfolios that line up in such a way that for a given level of return, they expose us for the least amount of risk potentially to get that kind of return. And that any portfolio that is not on that efficient frontier line along here is deemed to be inefficient. In other words, we may be taking on more financial risk than is necessary to achieve the goal return. So let me give you an example here. So this is portfolio A. It's deemed to be an inefficient portfolio. And we say that because when we look at modeling different portfolio returns and we look at the historical risk level of a portfolio and the historical return numbers it generates for us, we see when we do the analysis that portfolio B is more efficient, meaning for less return, okay, so portfolio A, when we look historically at its performance and its risk is variability of return, here's where it lands on the risk continuum, and then we look at portfolio B, it lands here on the risk continuum. So let's say that both portfolios were going to generate that 4%. Obviously, I would want portfolio B. If my goal was to try to get 4% returns, that's what I needed in order to fund my retirement planning objectives or my specific financial objectives I'm shooting for. Then obviously I'm going to go with portfolio B. Why take on more financial risk than is necessary? Why take on an inefficient portfolio strategy? Now on the flip side, let's say that I was okay with this level of risk. I know that on the efficient frontier is portfolio C, and portfolio C has the potential to generate 7% returns. Now, it has a higher degree of year-by-year fluctuation, but over time it will provide us with a high probability of getting more return. And so again, that's the way the discussion should be framed. When I talk to a client, it's more about, first of all, what do we need to get as a return? Let's not take on more financial risk than is necessary to get the return. So the client says, well, I'm prepared to take on some more financial risk, and there may be some reasons for that. Then we'll try to find a portfolio along the efficient frontier that has a high probability of getting that return. When we work with our own clients, we're always focused on this because portfolio efficiency is critical. The question you want to ask yourself is when you're working with an advisor, is the portfolio efficient? Is there some sort of mechanism that they use to model these portfolios and try to find the efficiencies that need to be there so you don't take on more risk than is necessary? So when we model portfolios, again, we're taking a look at such things as real estate, government bonds, corporate bonds. In the stock market, we're looking at U.S. stocks, Canadian stocks, international stocks, and within those categories you've got mid-cap, big-cap, and small-cap stocks. Now, one of the reasons for that is embedded in this whole efficient frontier idea is something called negative correlation or cross correlation. So let's just take a look at that for a minute. So when you talk about the idea of cross correlation or negative correlation, essentially what we're talking about visually is I could have, let's say, investment A in my portfolio, and when I look at its performance over time through the current economic cycle, it might have looked like this. So in some periods it's doing well and it's going up in value, in some periods it's going down in value. So it's on this oscillation over time. Now, over time, the portfolio is going up in value, but there is this fluctuation that goes on. And then if I could find account B and its correlation looked like this, then what happens over time is I've got an asset that fluctuates inversely to asset class number A. So as A goes down here, hopefully I've got an investment in my portfolio that's going up in value. Now the classic example of this is that when you look at portfolio design, the reason you'll often see, real estate, stocks, and then government bonds as well as corporate bonds in a portfolio as an example is those asset classes in many cases are negatively correlated. In other words, through a couple of economic cycles of anywhere from, let's say, 4 to 8 years, you're going to see periods when not all those investments are synchronized. In other words, they're not all going to go up at the same time. They're going to counterbalance one another through economic cycles. So the idea is to try to get a portfolio that over time is going to hit that long-term goal return for the lowest level of risk. The way that we manage risk and reduce it is through cross-correlation, negative correlation on the portfolio. Again, it's one of those areas that I don't think, get focused on enough. We often see portfolios of clients coming to us who are dealing with advisors, and it's often a bit of a dog's breakfast in terms of what's in the portfolio. There has been no focus to the correlation of assets. Clients are taking on more financial risk than is necessary. It doesn't mean that they wouldn't get the terminal return down the road that they're shooting for, but they were taking on way more financial risk than is necessary. Now, the reason that is really important to focus in on is study after study confirms that for most people, the reduction of risk and the emotionality of their portfolio experience is critical, because if it gets too high, they bail on a strategy. So even if the strategy is a good strategy, even if there's high quality investments in the portfolio, there can be a very high probability that that client might bail if they're exposed to too much risk. So it's a very important area. Okay, so let's leave that, the notion of efficient frontier and negative correlation, and continue with our presentation. Okay, this is a helpful chart to continue the conversation about asset mix, its impact on performance, and its impact on risk. Now, again, this chart looks at a long period of time. So this is the mixture of assets, defines the potential range of returns. We'll take a look at that. And this is over a period of 1901 to 2016. And we're looking at various kinds of asset allocations. So we're going from a portfolio that's 100% fixed income to a portfolio that, let's say, is 60%, or I'm sorry, 60% fixed income, 40% equities. And then on the right-hand extreme side of this, we've got a portfolio with 100% equities as an example. And what we're looking at is basically the indexes. We're looking at a bond index that tracks the performance of bonds, and we're looking at a stock index. In this situation, it's the Canadian stock market over a long period of time. So what you see here is that over that time period, bonds provided returns of 4.7%. The return could potentially in any one year be minus 4.5% and 19.3%. Now, I'm not going to go into a discussion today about why there's such a range of return potential on government bonds or the bond index. That's for another video. But suffice it to say, it was a 4.7% return. If I go kind of the middle of the chart here, so 50% stocks, 50% bonds, you can see that the long-term performance was 7.2. So the most conservative portfolio from a risk standpoint for the most part, although this portfolio here was actually more conservative. That's 80 or 90% bonds, 10% stocks. When you added a little bit of stocks to the portfolio, it actually reduced the risk here. So these portfolios in general are the least risky for the most part on this continuum. And then we go to this balanced portfolio, had returns of 7.2. We'd expect that because there's more stocks in the portfolio. And its range of performance was greater, minus 7.3 to plus 21.3% in terms of its short-term swing rate. And if we go all the way across this chart to a portfolio made up of 100% Canadian stocks, the long-term returns 8.89, just under 9%, and you've got a range of minus 19.1 to plus 36%. Okay, so this is the average return. So schematically, it sort of, demonstrates that as you add more growth to the portfolio, we would expect the performance would go up, but so too is the fluctuation or variability of return, or what we call risk on the portfolio. Now, when you work with your advisor, the discussion needs to go something like this. Okay, what are your goals? Okay, what do we need to get as a return to achieve your goals based on the current assets you have, how much you're saving, how much time we're working with? Great. Now that we know that goal, we understand that we need to get 6.8% returns on average on the portfolio. Well, that portfolio is basically at 60% income investments, 40% stock investments, and over time we'd expect that that portfolio would generate returns sufficient to reach your goals. Okay, that's kind of the starting point of the discussion. Now keep in mind, this is just an example. You have to build portfolios in the current environment, the current economic, tax, political environment. There's a lot of things that go into the design of portfolios, but in general, you want to keep this basic principle in mind. What kind of investment mix is going to drive the returns? Obviously, I might get the best return if I go 100% equities, but do I want to take on that level of risk? And if I confirm that I only need 6% or 5% to get my goals achieved, why take on this extra level of risk to achieve those goals? Now, for younger clients, they might go, listen, irrespective of whether I need 5 or not, I have time on my side, so I'm going to take on more financial risk and try to get better returns in the portfolio. But again, the basic idea is define what you need to get as a return. You do that through financial analysis and forecast and talking about goals, and then we begin building the asset mix. So hopefully that makes sense. Now, once that mix is put together, it's really important that we go through an exercise where we're actively rebalancing the portfolio. Again, this is the idea of the efficient frontier, and if we never rebalance the portfolio, over time, if equities outperform bonds, your portfolio will progressively get more and more risky. So it's important to rebalance the portfolio. So in an ideal world, when capital markets are doing well and stocks are doing well, you want to fine-tune and rebalance that portfolio and add back to the bond market or underperforming assets. And the reverse is true. If the stock market goes down in value, for that part of the portfolio not needed for short-term liquidity in the next year to 3 to 4 years, you'd want to take money from bonds or cash equivalents and buy back into the stock market when there's an opportunity or a bargain that's available to you as an investor. So this ongoing rebalancing is really important. Well, it's our hope that you found the discussion on asset mix important. It's really just an introductory primer, but it's a really critical component to successful retirement income investing. We have a process that is called the gap analysis. It looks at whether you have enough. Typically, when we talk to people who are looking at retirement coaching services, whether they articulate it or not, they're concerned about longevity risk, outliving their capital, concerned about how much income they can afford to spend. They're concerned about market risk and getting the returns that we need, but not getting really hurt if the markets go down significantly in value. So these concerns swirl around. The starting point is to do a financial analysis and forecasting. And so if you go to our website, there's a link to take you to our website on our coaching services. Also, you can get some free resources. There is a tip sheet for retirement. There is a worksheet that gives you a listing of things you need to begin thinking about for retirement. We also have a snapshot that looks at the analysis that we prepare for people through our complimentary process. So make sure you take a look at those information pieces, and there's a video that unpacks our process in more detail. If you'd like to reach out to our office, it can be reached at shaunhumphries.com, humphries at assante.com, and the phone number is 204-977-8049. Of course, feel free to visit our website at shaunhumphries.com. Anyway, I wish you all the best in your retirement income planning. And again, we'd more than welcome a conversation if you'd like to explore our retirement coaching services. You take care.